Good morning, everybody. It is Tuesday, May 27th, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macro and economic commentary. As a reminder, you can follow me intra-week on LinkedIn, Herb Morgan, or on X at Herb W. Morgan if there's some commentary that needs to be said. This presentation you are seeing and or hearing in the case of a audio podcast only has been prepared by us, Cantor Fitzgerald Investment Advisors. It is designed to be used by financial advisors, but also individual investors. Regardless of which you are, you're expected to make your own investment decisions. Nothing in here should be treated as investment or tax advice. No recommendation for the purchase or sale of any securities. The views are mine and mine alone. May differ from the views of CFIE's parent affiliates or other portfolio managers here at the firm. Let's get into it. We had a really rough week. You can see small cap stocks led the way down about 4%, large cap, big cap down about 2.5%. Back in the red for the year on the domestic indices. International keeps defying the odds despite sort of softer fundamentals. You know, they're on a different path as it relates to interest rates. The Europeans have cut, the ECB has cut. They don't have the big growth companies. I don't know how long this outperformance is going to last. I think it may be short-lived, and I expect leadership to return at some point back to the U.S. Interest rates kicked a little higher on the heels of the one big beautiful bill and the concerns that it was going to add significantly to deficits and ultimately debt. I think the administration's plan is they think they can outgrow that increase in debt. We'll see. Only history will tell us. Only time will tell us. But bond markets rightfully concerned. The 20-year plus Treasury index down 2%. The 10-year riskless U.S. Treasury about 4.5%, and 30-year bonds now over 5%. Over 5%. Some economic data last week, not too much, plus we're sort of wrapping up on earnings season. Weekly initial claims for unemployment. This is such an important indicator for somebody who wants a real-time look into the economy. We remain doing really well there. We fell to 227,000 on the week. This is also the period that coincides with the non-farm payrolls report, the VLS jobs report, essentially, that we'll get the first Friday in June. So it looks like it's going to be a good report. You know, weekly initial claims at this level are just incredibly low. And signals that the labor market continues to be robust in the U.S. Furthering the good news, economic news last week, was this flash reading from S&P Global on manufacturing for the month of May. We're still in May, so next week we will get a final reading. But the flash reading is usually a very good indicator of where we are. And we shot up, you can see here, we shot up to 52.3. We were just a little bit higher than that a couple of months ago. But other than that, it's one of the best readings in the last 3 years. It's also the fifth consecutive month above 50. So that's certainly good news. We like that. We're happy with that. And remember, manufacturing is about 15% of the economy. The services sector, we also got a flash reading there, has been the big driver. And last month, April, everybody was a little concerned because it had gotten closer down to 50, and there was concern maybe this expansion, you can see right there, might be coming to a little bit of an end, but it shot right back up for the May flash reading again, 52.3. That was above the estimate of 51. Although employment fell just barely below 50, we're not going to panic about that yet. The other sort of negative news contained in that was prices charged rose to the highest reading since April 23, just when we'd been starting to get good inflationary news. Here's one nugget, it's just one nugget that might be not as positive. Then we've got residential real estate. Residential real estate is just really kind of ugly, right? It's just everything about it right now is ugly, unless you just are sitting in your home and making your mortgage payment and knocking down debt every month. It's not so ugly for you. But you can see here with existing home sales, they fell 0.5%. The estimate was that they were going to go up 2%, so that's a big difference. They are down about 2% from a year ago, but affordability remains the issue of the day. 21% increase in listings, also contained in that report, suggests perhaps softness ahead. Maybe affordability will start to take care of itself. But the other thing hurting is, of course, mortgage rates ticking up on those interest rate fears, up to almost 7% again. That will put a lot of buyers out of the market. New home sales did surprise and actually spike. They surged almost 11%. The estimate was they would be down 4%. And what buyers are doing is figuring out ways to get incentives in there. They may be a little bit better, they're differently capitalized than an individual selling a home. So for first-time home buyers, or really any home buyer, if there's an incentive that buys that rate down, they sort of move some of that into the price, flip things around, find ways to get them qualified, you're seeing a little bit of movement there. But this number on new home sales is still very low, not particularly good, nothing to write home about at all. Wrapping up earnings season, 478 names reported, average earnings surprise 8%, 368 of the 478 beat, only 92 of the 478 disappointed on earnings. Earnings growth across the board, with the exception of real estate, positive. Real estate was down ever so slightly. Even energy, kind of a surprise there, because price of energy is coming down. I would expect the quarter we're in, since we got oil now down around $60, the quarter we're in, you might even see that go negative. And that's not necessarily a bad thing, right? When you calculate the earnings, if energy is not so good, because it says that inflation is starting to get a little under control. And then we just sort of step back to 20,000 feet and ask ourselves, what do we feel about stocks versus bonds? This is a question, Glenn and I ask each other at every meeting. And one of the easiest things to look at is the earnings yield versus the risk-free yield. The earnings yield of the S&P 500 is at about 4%. See it right there. That's the inverse of the PE. That's the E to P. And we say, well, 4% or 4.45% on a risk-free treasury. Buy a treasury today, hold it for 10 years, you will get 4.45% on a nominal basis. So how do we interpret that? What does it mean? Well, it's not always simple. There's not any hard and fast rules, but one of the ways to interpret it is you say stocks are overvalued and they could come down. So, okay, interesting. Or you could say bonds are undervalued. Stocks are over, bonds are under, meaning bonds could rally big from here, right? Or you could say, well, no, I think the market is just underestimating the earnings estimates, and we're discounting. The reason we are underestimating, we're discounting the future growth, and the future earnings growth is going to be so good because of AI, because of 5G, because of innovation, and all of these things, that the earnings estimates are too low, and the earnings, which, to be fair, it's been happening the last couple of years, are out delivering and growing into the higher PE multiples, or inflation expectations are just too high. They could come down. So there's all these different ways to look at this. It doesn't mean you should panic and sell your stocks and go all bonds. But from our perspective, we do in the short term, I think, still again, just like we did at the beginning of the year, because that multiple's gotten high in that 21 plus range, we do kind of favor bonds. Who knows what's going on in the geopolitical situation, trade situation, legislation around tax. We don't know for sure there. We talked about last week some things that came out of the House. Let's wrap it up with this week's economic data. Yesterday was Memorial Day, so there was no data of durable goods. House prices from Case-Shiller and FHFA today, along with consumer confidence. May Fed minutes will be tomorrow. We'll be sure to be reading those. That's where you'll catch me tomorrow. Weekly jobless claims at 2:30. First quarter GDP, I'm not concerned. We already got that prior report at -0.3. It's expected to be unchanged from there. Pending home sales, personal income spending, PCE inflation number, very important. 0.1 is great. Comes in much above that, not great. Comes in there or below, great. That'll help markets. Chicago PMI and consumer sentiment. Thanks for tuning in. I'll be back to you again in 1 week. We're available on all the audio podcast formats as well as on the YouTube with the charts and the graphs. I do thank you.